Hello everybody, how are you? Welcome to KSJ Teaching and welcome to the financial management revision sessions which we have been doing. And we are going to continue with our next session, that is on ratio analysis. We have already done the working capital part. In the working capital, we discussed about working capital, cash management and debtors management. Now we are moving on to another very important chapter, that is ratio analysis. And almost in every attempt, we can expect a question. We have been expecting and we have been getting a question on ratio analysis. So that important question it is. What type of a question can be asked, sir? Mostly the balance sheet questions are asked in the ratio analysis, where you are given the certain ratios, certain information is also given and you have to calculate the ratios and fill up the balance sheet. That is the most commonly asked question from ratio analysis, right? So for that, what is important is to understand each and every ratio. What is the meaning of each and every ratio? What each and every ratio wants to signify. So we'll quickly go through with all the ratios and I will tell you certain things that you have to remember, right? Okay, so let's start with what is a ratio analysis? A ratio analysis is the relationship between two or more financial variables. See, whenever the top management of the company wants to interpret the financial health of a business, it is not possible for the top management to read the lengthy financial statements, right? The whole of financial statements, they do not have that much of a time. So what they can do is they are trying to interpret the financial health through the financial ratios. That is what is ratio analysis. And in the ratio analysis, what we are trying to do is we are trying to set up a relationship between two or more financial variables, that how those financial variables represent the health of the business. Okay, so starting with this, we have the various types of ratios, liquidity ratios, capital structure ratios, then there are profitability ratios, then there are other ratios also. So starting with the liquidity ratios, what are the liquidity ratios? We'll quickly go through with them. The liquidity ratios tell us about that how liquid cash, I can say, and the cash equivalents the business is having, right? That in case of emergency, do business has the enough cash or the cash equivalents to pay off the liabilities also? Clear? So in that, the first and the very important ratio that is there is current ratio. Current ratio is current assets divided by current liabilities. That is, what are the current assets? Current assets are any assets which can be converted into a cash within a period of 1 year. What is a current liability? Any liability which is to be paid within a period of less than 1 year, right? That is a current liability. Now, what this current ratio is trying to tell us? The current ratio tells us that if you have to pay someone 100 rupees, how much of the cash you should have in your pocket. The current ratio says you should have at least 200 rupees in your pocket, so that after paying off those 100 rupees, you have the extra cash, the extra money with you, right? So in this case, what is your ideal ratio? The ideal ratio is 2:1, right? The ideal ratio in this case is 2:1, current asset divided by current liabilities. That if you have to pay someone 100 rupees, how much of the current assets should be there in your pocket? How much of the cash or cash equivalent should be there with you, right? You should have always more of that, more of cash or more of cash equivalents in your pocket, so that after paying off 100 rupees, you are still left with 100 rupees, so you can eat some burger pizza on your way back home. Simple, sir, right? Remember this thing. Now, in the examination, in any kind of a question, sometimes how the information can be given to you. Let's see that how the information can be given and how to calculate the various things, right? So it might be given to you that current ratio is not required to be calculated, but the current ratio is given to you, that is 2:1. Then he says working capital, then he says that working capital is equal to rupees 5 lakhs, right? This is the information that is there in the question, and you are required to calculate current assets and current liabilities. This is what you are required to calculate. Now, how to solve this kind of a thing? Very simple. Although it is simple, you must have done it, but still it's my duty to tell you that what types of things can be asked in the question in the examination, right? Okay, so how you do it? Current ratio is 2:1. What is current ratio, sir? Current ratio is current assets divided by current liabilities, that is given as 2:1, right? From here, can I write it current assets is equal to 2 times the current liabilities? I'll take the current liabilities here. Current assets is equal to 2 current liabilities. I can write it like this. Very simple, sir. So this is my first equation. Then working capital is given to you as 5 lakh, and the working capital we have discussed the working capital equation, that is current assets minus current liabilities is equal to 5 lakhs, right? This condition we have already, this situation we have already studied. Now what I am going to do is the current asset, this value of current assets I will substitute here, that is 2 current liabilities minus current liabilities is equal to 5 lakh. So from here, can you tell me what is the current liabilities? Current liabilities is simply 5 lakh, sir. And what is your current asset? Current asset is 2 multiplied by current liabilities, that is 2 multiplied by 5 lakh. So current assets comes out to rupees 10 lakh. So this is how the information can be given in the examination, and this is how you have to calculate the current asset and current liabilities in that case. Okay. Moving on, the next is the quick or the liquid or the acid test ratio. This is quick asset ratio, liquid asset ratio, or the acid test ratio. This is current assets minus inventory. This we call it as quick assets, or we also call it as liquid assets, right? Divided by current liabilities, or here you can also write it the liquid liabilities. Here you can also take the liquid liabilities. Sir, what is liquid liability? Current liabilities is, as you all know, how to calculate the current liabilities, right? Sundry creditors can be there and any other things can be there. But what is there in case of liquid liabilities, sir? Liquid liabilities can be calculated as current liabilities minus bank overdraft minus cash credit. So if bank overdraft and cash credit is there given in the question, you have to calculate the liquid liabilities, or if these two items are not there, then liquid liabilities are equal to current liabilities only. You can take it anyways, right? And what is the quick asset, sir? That is current asset minus inventory. Now quick asset tells us that here in case of current asset, we say any cash or cash equivalent which can be converted within a period of 1 year. Here in case of quick asset, say we can't wait for 1 year, sir. We have to convert that cash equivalent into cash quickly, sir. Let's say within a period of 4 to 5 months or maximum 6 months. Now inventory might take time. The raw material will take its time to be converted into finished goods, then finished goods into sale. It will take its own time. You can't say that we can easily convert inventory into 6 months, right? So that is why inventory is removed from the quick asset, because the inventory will take its own time for the conversion into cash, right? So that is why current assets minus inventory divided by either current liabilities or liquid liabilities. The liquid liability means current liability minus bank overdraft minus cash credit. So this is how it is to be calculated. Now, another kind of information which may be asked related to the liquid liabilities, which may be given in the question. Let's see what is given to you. You are given that current assets is 5 lakh rupees, right? And current liabilities are given to you as 2 lakh. And then he says that liquid ratio, quick ratio, or asset test ratio, it is one and the same thing, right? So liquid ratio is 1:1. Calculate. Now from here, what he will ask you to calculate, he will say calculate value of inventory. How can you calculate the value of inventory? Now you are given the liquid ratio. What is liquid ratio, sir? Liquid ratio is liquid assets divided by, I'll say liquid assets divided by current liabilities is equal to 1:1. Now what is your liquid asset or the quick asset? Liquid asset is current asset minus inventory divided by current liabilities is equal to 1/1. Now you are given the value of current asset and current liabilities. What is the value of current asset? That is 5 lakh minus inventory is equal to current liabilities. I will take here, that is what is the value of current liabilities? That is 2 lakh. So can you tell me what will be the value of inventory from here? That is rupees 3 lakh. Clear, sir? So this will give you the value of inventory, that comes out to 3 lakh, that is 5 lakh minus 2 lakh rupees. 3 lakh is the value of inventory. Clear, sir? Any doubts on this thing? So this is regarding the quick assets. Then absolute cash ratio. Now absolute cash ratio says that only those current assets which can be quickly converted into cash, let's say within a period of 1.5 months or 2 months maximum, right? The current asset was any any current asset which can be converted into cash within a period of 1 year. Quick asset is which can be converted into a cash within a period of, let's say, 5 to 6 months. The absolute cash ratio says any asset, any current asset which can be quickly converted into a cash, let's say within a few days or within a month, that is cash plus marketable securities. Now marketable securities, you can easily go to the market and sell those securities, right, in the stock market, divided by current liabilities. That is known as absolute cash ratio, right? Then the last one is the basic defense interval measure. The basic defense interval measure says the quick assets divided by cash expenses per day. He says that whatever the cash expenses are per day, for how many days you will be able to meet your expenses from your quick assets, from those assets which can be easily converted into a cash. For how many days the business can survive by paying off the cash expenses, everyday cash expenses from the quick assets. That is what is known as basic defense interval. That is for how many days a business will be able to meet its daily expenses from its current or the quick assets. Clear, sir? So these were all the ratios. These are known as liquidity ratios. Moving on to the next set of ratios is the capital structure ratios. What is capital, sir? The capital is the money that you are using in the business for running the business. And for the capital structure ratios, you only have to remember one picture. I'm going to draw a picture. You only and only have to remember that picture, sir. That's it. You don't have to do anything else. If you are able to remember that picture, the half the problem will get solved there, sir. More than half the problem is solved there, sir. Great, sir. What is that picture? Let me tell you, sir, what is that picture? So this is a simple balance sheet, sir. In the balance sheet, what we are writing is, here we write equity share capital, right? Then I'll write reserves and surplus. You just have to remember this balance sheet for all the capital structure ratios. You will be able to do all sorts of calculations from this, right? Then we have preference share capital. Then next we have long-term debt and long-term borrowings. It is one and the same thing, right? Then we have current liabilities. Right? Sir, we know this balance sheet. क्या सर, क्या बनवा रहे हो? हमें पता है सर ये बैलेंस शीट है, ठीक है ना? क्या बच्चों वाले काम करवा रहे हो सर? रुको जरा, सब्र करो, चलने तो दो आगे. चलो ठीक है सर, आपने कहा है तो कर लेते हैं सर सब्र. फिक्स्ड एसेट्स, then we have current assets, right? Then we have accumulated losses, right? Then we have some fictitious assets which are not actually assets, right? Fictitious assets, for example, the preliminary expenses, right? Or promotional expenses can be there. So all these are what are fictitious assets, sir. Now I am going to give certain terminologies to this thing, right? This is the simple balance sheet. All of you know about this balance sheet. I need not tell you about this. What is equity share capital? What is reserves and surplus? No, I'm going to give you the terminology, specific terminology for the combinations. Now, what is there, sir? If you combine these three things, this is known as equity. This is what is known as equity, right? Equity or proprietor funds or owner's capital. So we'll discuss about it. Broadly, it is known as equity. This is known as debt, right? This is known as current liabilities. You all know. This is known as total debt, right? This is known as total debt. And this part from equity share capital, reserves and surplus, preference share capital, and long-term debt, this is known as total funds. This is known as total funds, or what we call it as capital employed. Capital employed. Right? And if you consider only this part, the equity share capital and reserves and surplus, this is known as equity shareholders funds. This is known as equity shareholders funds, right? And this is known as your total assets. That's it. Right? These are accumulated losses and fictitious assets. These are who will bear these accumulated losses. What will be the impact? The owners will be bearing this thing. Right? So this will be subtracted from while calculating the equity and equity shareholders funds. Clear? Who will bear this? The owners will bear this, sir. Very simple. Now, for capital structure ratios, all the calculations will be done from here only. Come to that. Important terms. These are the important terms that I have explained in this whole diagram, in this whole picture. You have to remember this picture of the balance sheet. That's it. Let's see. What is a debt or the borrowed funds or the loan funds? What is debt, sir? Debt is the long-term debt. How you can calculate? If the long-term debt is given to you, simple, long-term debt, sir, or total debt minus current liabilities, that will give you long-term debt, or capital employed minus equity will give you again debt. So there are various ways in which you can calculate, sir. Debentures plus long-term loans from the bank's financial institutions, or you can also calculate it as total debt minus current liabilities, that will also give you the long-term debt, or you can calculate it as capital employed minus equity, that will also give you what? Capital employed minus equity will give you long-term debt. That is why I'm saying one calculation can be done in the different ways. The only thing is that this image should be imprinted in your mind. अच्छे से छपनी चाहिए सर दिमाग में, अगर छप गई तो गलती होने के चांस ही नहीं है सर. Right? So this is what is debt. Then equity or net worth or shareholders funds or proprietors funds or owners funds or own funds. So these are the different names by which you can get the things in the paper. Right? It is not necessary that every time the word equity will be used. It is not necessary that every time the net worth will be used. It is not necessary that every time the shareholders funds will be used. Anything out of this can be used, right? So how you can calculate equity? That is equity share capital plus preference share capital plus reserves and surplus. That is what I told you. Equity share capital plus reserves and surplus plus preference share capital minus the accumulated losses and the fictitious asset, right? Minus miscellaneous expenditure plus accumulated losses, right? So this plus is for this part. Right? Miscellaneous expenditure is what? This is basically the preliminary expenses, right? These are the promotional expenses that we have done. Fictitious assets, sir. Any fictitious asset, you have to remove it while calculating the equity. Now, what we are using the word, it is the equity in which the preference share capital is also included. If the word used is equity shareholders funds, then it is only equity minus preference share capital, or what we can write as equity share capital plus reserves and surplus, equity share capital plus reserves and surplus. This again is equity shareholders funds. Total funds or the long-term funds or the capital employed or the investment that I have explained, that is debt plus equity. That is why I told you, just remember this, sir. Debt plus equity, that will be your total funds, right? Or fixed assets plus net working capital will also be capital fund. How, sir? What is fixed asset? Plus current asset minus current liabilities. You can write it as fixed assets plus current assets minus current liabilities. That will also be capital employed, sir. What is current asset minus current liabilities? That is working capital that is working capital. That is why I'm saying fixed asset plus net working capital, that is also capital employed, sir. Right? So the one thing can be calculated in the different ways. Just remember this. Just remember this. The rest, everything will depend upon what is the information given in the question. According to that, you have to play with the question, sir. As per the information given in the question, you have to play with the question. That is the most important thing. Moving on. Total assets, that is net tangible fixed asset plus total current assets. Here the word used is tangible fixed assets. If there is goodwill, that is not to be considered as a fixed asset because that is not a tangible fixed asset, right? So here, if you have goodwill, that is not to be considered because what you have to consider is only and only the tangible part of the fixed assets, right? Total fixed asset is net fixed asset, that is the gross block, that is minus depreciation. Gross block minus depreciation, that is net fixed assets, right? So these are the various ratios. Now debt to total funds or the debt ratio, that is out of the total funds that is employed in the business, whether in the form of equity share capital, preference share capital, reserves and surplus debt, what is the proportion, what is the amount of debt, right? So debt to total funds, or this is also known as debt to capital employed. Total funds or capital employed, one and the same thing. Debt divided by capital employed. The similar ratio is equity to total funds, that out of total funds, what is the proportion of equity that is invested in the business, right? Here the word used is not equity shareholders fund. What is the word being used here? Equity. Here it means the equity share capital plus reserves and surplus plus preference share capital. So you have to be very careful with what is the terminology, what is the word that is used, whether it is equity given, whether it is equity share capital given to you, what is given in the examination, you have to work according to that. Clear? Next is the debt equity ratio, that is debt divided by equity. What is the ratio of debt to the ratio of equity, right? Then capital gearing ratio. Capital gearing ratio is preference share capital plus debt divided by, not equity, this is equity shareholders funds, that is equity share capital. Now, why is this ratio, sir? Because try to understand this preference share capital and debt, these are the fixed charge bearing instruments. Fixed charge bearing instruments. What does it mean, sir? Fixed charge bearing instruments. What do you mean by this? Sir, on the debt, you have to pay a fixed rate of interest. For the preference share capital, you have to pay a fixed rate of dividend, isn't it? Yes, sir, we have to pay it. So, what this capital gearing ratio, we are trying to analyze that what is the funds on which we have to pay the fixed charges to the funds which do not have the fixed charges. Because for the equity shares, if there are profits, the equity shares will get some dividend out of it, or they will not get anything out of it if there are losses, right? So this is what we are going to check. Proprietary ratio is that proprietors funds divided by total assets, that how much of the total assets have been funded through the proprietors funds, through the owners funds, right? And similarly, debt to total asset ratio tells us that how much of the total assets have been funded through debt, that is the outside money instead of the owner's fund. The last is the fixed asset to long-term funds ratio, that how much of the long-term funds means the debt, has been used for fixed assets. Here what we are saying is out of the total assets, how much assets have been funded through debt funds. Here we say how much of the total assets have been funded through proprietary funds. Here we say out of the total long-term funds or the debt, how much of the funds have been utilized for fixed assets. That is fixed assets to long-term funds ratio. Clear, sir? So these were all the capital structure ratios, and as I told you that you have to remember only the balance sheet that I have told you. If you are able to remember this much, then most of the calculations you will be able to do it on your own. Moving on to the next set of ratios, that is profitability ratios based on sales, right? Based on sales, that out of the sales that you have done, what are the profits that you are earning? Now, profits can be various types. One is the GP ratio, one is the operating profit, and one is the net profit. So, What do you remember? What do you want to remember for this ratios? Let's see. For profitability ratios, what do you have to do? Profitability ratios. Okay. Now, for profitability ratios, what you have to remember is the trading profit and loss account. Sir, that we all know how to prepare it. Yes, I know you people are expert at preparing the trading and profit and loss account. You people will be knowing more than what I know on how to prepare the trading and profit and loss account. That's guarantee, sir. Right? Because you people are super experts in this thing. But I want to tell you a very simple thing. Great. Let's do. So what you're writing here is buy sales, right? Buy closing stock. So I'll prepare a very simple one. Don't worry. I'm not going to complicate the things here. Closing stock. Here you have two purchases. This is what you are having. Two opening stock first, not purchases first. First you have to write opening stock, sir. Two opening stock, then two purchases, two direct expenses, and then finally what we have is two gross profit, isn't it? To gross profit. This is a simple trading account that you have been preparing since you were kids, the small kids, the little kids. This is what we have been doing. Yes, sir. From here, what we take is by GP, by gross profit. Yes, by gross profit. Then we take by. Now, what I'm going to write here is by operating income. By operating income. Sir, any income which is related to the operations of the business, that is what is known as operating income. And if there is any non-operating income, that is by non-operating income. Operating income can be like scrap income can be there, sale of scrap. Non-operating income is like rental income is there, right? On this side, what you are going to take is two operating expenses, any expenses which are not direct in nature, but which are related to the operations of the business. For example, factory overheads, right? Factory overheads are there. Then admin, selling and distribution overheads are there. Admin, selling overheads are there. So these are what? These are related to the operations of the business only, right? Then another thing that you have is two non-operating expenses. Two non-operating expenses, right? For example, loss on sale of asset. Loss on sale of asset. That is a non-operating expense for you, right? From here, what you get is two net profit. Now, this is the only thing that you have to remember for the profitability ratios. Only thing. Now, how to calculate the gross profit ratio? That is the gross profit divided by sales into 100. Very simple, sir. How to calculate the net profit ratio? Net profit divided by sales into 100. Now, what is operating profit? What is operating profit? Listen to here. Operating profit is gross profit plus operating income minus operating expenses. Right. So this operating profit can be calculated as GP minus operating income, plus operating income minus operating expenses. Or if the GP is not given, net profit is given to you. How you can calculate the operating profit in that case? Sir, in the net profit, you will add these non-operating expenses. You will add this and you will subtract the non-operating income. So here we can also calculate it as net profit, add non-operating expenses minus non-operating income, right? So from here itself, we are going to do the reverse working, sir. In the net profit, while calculating the net profit, this non-operating expenses was subtracted. I will add it back. This was added. I will subtract it to get the operating profit. To get what? To get operating profit. So this is how the operating profit ratio has been calculated. Next is PV ratio. You all know contribution by sales into 100. We have already done it. The last one is operating ratio or the operating cost ratio. What is there is operating ratio or the operating cost. That is operating cost divided by sales. That out of the total sales, what is your operating cost, or 100 minus operating profit ratio. Right? 100 is what? That is your sales. Out of that, what is your operating profit? What is left is operating cost, sir. Right? So this is how the calculations regarding the profitability ratios has to be done. Now, coming to the next set of ratios, that is coverage ratios. Now, what does this coverage ratios relate to? So, these coverage ratios are related to the fixed financial charges. Related to the fixed financial charges. What are the fixed financial charges, sir? Fixed financial charges are two. One is interest on debt. The first is interest on debt. And the second one is the preference dividend. The second one is the preference dividend, that whether these ratios tell us that whether the business is having the sufficient cover in the forms of profit to pay off the interest on debt as well as the preference dividend. What I am saying is, I am going to repeat it again. If you want to write it, you can write it down. That do the business have sufficient cover in the form of profits to pay off the fixed financial charges, that is interest on debt and the preference dividend, whether you are earning the sufficient profits from the operations of the business. Profits, what I'm using the word is whether you are earning sufficient profits from the operations of the business so that you are able to pay the interest also and the preference dividend also. Now, what do you need to remember for this, sir? For coverage ratios, what is required, sir? For coverage ratios, what is required? Sir, you are required to remember the income or the profit statement. What you are going to require is the income or the profit statement. Right? How to prepare this income or profit statement? Let's prepare it, sir. What's the issue? Let's do it. So first thing that you will get is sales minus cash operating expenses minus cash operating expenses, right? Minus non-cash operating expenses. Now, can you think of an example of this? Sir, what I'm writing is, sir, it is an operating expense. This expense is related to the business, but it is non-cash. Non-cash means there is no actual cash outflow in this case, but still it is an expenditure. Sir, how is it possible? Yes, sir, is it possible? Depreciation, sir. Depreciation is the biggest example of the non-cash operating expenses. Okay, sir. Minus the non-operating expenses. Minus non-operating expenses, which we have already discussed. So from here, what you get is, you will get EBIT, that is earnings before paying the interest on debt, minus interest on debt. It is a fixed financial charge. What you will get is EBT minus the taxes. What you will get is earnings after taxes. Earnings after taxes. Now, from these, what you are going to pay is, from this, you are going to pay the preference dividend. So one thing is clear, sir, the interest on debt is a tax deductible expenditure, whereas preference dividend is not a tax deductible expenditure. Preference dividend you have to pay after paying off the taxes. Right? So here, what will be left is earnings for equity shareholders. Earnings for equity shareholders, or this is also known as residual earnings. This is also known as residual earnings. And this income statement is going to be used at many places, not just this one place, sir. In the whole financial management, this income statement or the profit statement plays a significant role. Okay, so now we need to find out, let's say this is one thing that you have to remember. Now we are moving on to this part. What is the first ratio? It says the debt service coverage ratio. That means what are the two things that are required to be paid in case of a debt? Sir, if you talk about debt, the first thing that you have to pay is you have to pay the interest on debt. Secondly, you also have to pay the principal amount of the debt. Right? You have to pay the interest on debt and you have to pay the principal amount of the debt. So you want to know whether you are earning sufficient to pay off the interest as well as the installment amount. Right? So earnings for debt service divided by interest plus installment. Now regarding this installment, make a small change here. What I'm going to write is principal. This is only and only for installment part. I'm writing the principal divided by 1 minus tax rate. Why I'm writing like this, I'll let you know in a while. Right, first is what is the earnings for debt service? See, the interest is to be paid from where, sir? The EBIT. So first focus is whether we are earning sufficient EBIT from the business. But in case of EBIT, we have subtracted the depreciation also. Right, so we say we need to find out whether what is the actual cash. What is the actual cash available with us to pay off the interest on debt? So in the EBIT, I will add depreciation, sir. Right? Another way is, he says, the taxes you are required to pay. Take net profits after taxes or earnings after taxes. Right? Add back interest on debt in this. Add back interest on debt in this. Add back non-cash operating expenses, for example, depreciation and amortization, and add the non-operating income adjustment, that is the loss and sale of fixed asset. That will give you what is the actual amount of earnings from the business that you are having to pay off the interest liability, right? Net profit, you will add interest on that. What you will get is EBIT, but EBIT after taxes, after paying of the taxes, because in this earnings after taxes, you have already paid the taxes. So he says what you are getting, if this EAT plus interest on that will give you EBIT after taxes. Add back the non-cash operating expenses plus the non-operating expenses to find out from the business operations what is the cash that you are having to pay off the interest plus the principal amount. Right? Then interest is to be paid. That is absolutely fine, sir. Now, why have you written principal divided by 1 minus tax? Listen to it very carefully. For example, let's say the principal amount is, for example, let's say 1 second. I say your total earnings. 1 second. Okay, I say your total earnings is 1 lakh rupees, right? And the principal amount that you have to pay, the principal amount that you have to pay is, let's say 70,000 rupees, right? So you are earning 1 lakh rupees. From those 1 lakh rupees, you will pay a principal amount of 70,000. Yes, sir. What you will be left is 30,000. Now, I want to ask you, sir, let's say the tax rate is at the rate of 30%. Now, on which amount you will pay tax? Whether you will pay it on 30,000 or whether you will pay the tax on 1 lakh rupees. Let me know that. Whether you are going to pay this tax on 30,000 or whether you are going to pay on 1 lakh rupees. Sir, interest on debt is a tax deductible expenditure. So, principal amount is also tax deductible expenditure. Can you say that? Can you say that, sir, because interest on debt is a tax deductible expenditure, so the principal amount on debt is also a tax deductible expenditure. Is it a expenditure? No, sir. The expenditure is only the interest part. Debt is the principal amount is you are using someone else's money and you are to return that money. Simple. So on what amount you will have to pay tax, sir? You will pay tax on here, sir. 30,000 you will have to pay tax. So that means if you want to pay a principal amount of 70,000, you need to earn more. You need to earn more so that after paying off the taxes, you are left with 70,000. You are left with, let's say your earnings are 80,000. right? And you are paying 30% interest on that. That is how much? 24,000. Will you have 70,000 to pay off the principal amount? No, sir. So what is the amount that you have to earn? The earnings should be X. And 30% of X, that is tax. It should be equal to your principal amount, right? So here X1 minus 0.30 is equal to 70,000. So what is the X? X is 70,000 divided by 1 minus 0.30. That is why it is written as principal divided by 1 minus tax. That means how much of the amount is required. Required amount is 1 lakh rupees. So you have to see whether you are earning 1 lakh rupees, so that after paying off the taxes, you are left with 70,000 to pay off the principal amount, right? And the same logic will work for the preference dividend also, because if you see the statement here, the preference dividend is paid after taxes. So you need to find out what is the amount. Let's say the same concept will apply. Let's say you have to pay a preference dividend of 10,000 rupees, and the tax rate is, let's say, 50%. Now, how much you should be earning? Sir, you will have to not earn 10,000. You will have to earn more than 10,000, so that after paying off the taxes, you are left with 10,000 to pay the preference dividend. So what you will have to earn? X minus 0.50x, that should be equal to 10,000. So X1 minus 0.50 is equal to 10,000. So X is 10,000 divided by 1 minus 0.5. So preference dividend, this is preference dividend divided by 1 minus tax rate. In case of preference dividend also, we are doing the same thing, right? So this is clear. The first one is the debt service coverage ratio. Then is the interest coverage ratio. You have to pay the interest. Interest is to be paid from EBIT, right? Here, what you can take is EBIT plus, you can add here, what you can add here is, sir, you can add here the non-cash operating expenses. Non-cash operating expenses in the EBIT, sir. That's correct. EBIT plus non-cash operating expenses divided by interest, because the interest is to be paid from there. Now, preference dividend coverage ratio, preference dividend. What is the earnings that are required for preference dividend? That is earnings after taxes. Remember the statement, sir. The preference dividend is to be paid from here. That is earnings after taxes. So you need to find out whether you have sufficient earnings after taxes to pay off the preference dividend. The interest on debt is to be paid from EBIT. So you need to find out whether you are having the sufficient EBIT to pay off the interest on debt. In the EBIT, we add this non-cash operating expenses, so that we actually know what is the amount of cash that we have in the form of EBIT. The fixed charges coverage ratio, that is EBIT plus depreciation. The fixed charges are interest. This is not loan installment. It has to be here the preference dividend. Sorry, this is wrong. Preference dividend and divided by 100 minus tax rate, right? So fixed charges is preference dividend before taxes plus interest. We need to find out whether you have sufficient earnings from the business. EBIT plus depreciation, that is the non-cash expenses, because interest is to be paid on EBIT, and if we have sufficient EBIT only, then we will there are chances that we will be able to pay the preference dividend, right? So EBIT plus the non-cash expenses divided by interest plus preference dividend by 100 minus tax rate, right? Or it can be written as 1 minus tax rate. It is one and the same thing. 100 minus tax rate or 1 minus tax rate is one and the same thing. So these are all the coverage ratios. So for the coverage ratios, as I told you, what you have to remember is the income statement. That's it. The next is turnover, activity, or the performance ratios. So these ratios are what? These ratios somehow you have done it, sir. These ratios tells us that how quickly we are able to convert a raw material into WIP, then WIP into finished goods, then how quickly we are able to convert our finished goods into sales into debtors, how quickly we are able to convert our debtors into cash, right? By employing how much of the debtors we are able to, sorry, not debtors, by employing the total assets, how much of the turnover. Turnover means the sales that we are generating. Clear? So one is the raw material turnover ratio. Sir, on an average, what is the stock of raw material that you have, and what is the cost of raw material consumed in a year? That how many times in a year you have converted your raw material into consumption. Let's say in a whole year you have converted the raw material worth 1 lakh rupees, and on an average raw material that you are having is 10,000. So in a year, how many times you have converted this 10,000 worth of raw material so that your total cost of consumption is 1 lakh, sir? You have converted it 10 times. 10 times in a year, you have converted the raw material worth 10,000 into WIP, that is into consumption. That is why there is a cost of consumption of 1 lakh rupees, right? Then WIP material turnover ratio, that is on an average, what is the WIP and what is your factory cost or WIP cost? We have already discussed, sir, right? How many times you are converting your WIP into finished goods, and this factory cost is being incurred. Then finished goods or the stock turnover ratio, this is average stock of finished goods and the cost of goods sold, right? Then debtors turnover ratio, average accounts received, credit sales divided by average account receivable. To some extent we have discussed this in the working capital also, that on an average what is your accounts receivable, that is let's say 10,000 worth of accounts receivable are there, and in a particular period you have done a credit sales of 1 lakh, right? So how many times you are converting your debtors? 10 times, right? You are converting your debtors, you are receiving the money from your debtors. If you have the credit sales of 1 lakh, on an average accounts receivable is 10,000, that means you are converting your debtors into cash 10 times in a year. That is why the debtors are less, sir. Otherwise the debtors would have been 1 lakh, isn't it? Then creditors turnover ratio is credit purchases divided by average accounts payable. Working capital turnover ratio. Now what is this? Working capital turnover ratio means by employing a particular amount of net working capital, what is the sales that you are generating? Here the turnover means the sales. By employing a particular amount of working capital, the net working capital, not the gross working capital, by employing a particular amount of net working capital, what is the sales that you are generating? What is the turnover that you are generating? The next is the fixed asset turnover ratio. Again, by employing the net fixed asset, what is the sales that you are able to generate using those fixed assets? Right? These ratios tell us, these fixed asset turnover, net working capital, that whether you are utilizing your assets and the funds effectively or not. Capital turnover ratio is whatever the capital is employed in the business. What is capital employed, sir? Debt plus equity. By employing that capital, what is the sales that you are able to generate? Whether you are utilizing your funds, whether you are utilizing your assets effectively or not. Right? After that, so the major ratios we have covered. After that we have one more set, that is overall return ratios from the owner's point of view, right? From the owner's point of view, what is the return that you are getting? Now return on capital employed. What is the return that you are getting on the capital employed? The return here means, what is the capital employed? That is equity plus debt. That is fine, sir. What is the return? The return here says that whatever is the income from the operations, from the business, what you are earning. He says the EBIT, from it is reflecting as EBIT, or it can be EAT plus interest. If you want to see it, that after paying off the taxes, what is the earnings left from the owner's point of view, or sometimes it is also used as EBIT into 1 minus taxes divided by equity plus debt. This way also it can be used, that what is the earnings from the operation, that is EBIT, but he says the taxes are mandatorily to be paid to the government. So he says after paying off the taxes, pay off the taxes, sir, what is the amount that is left with the business? Right? Then is return on equity. Here it was the return on total debt. This is return on equity, EBIT by equity or EAT divided by equity. Then is return on assets, average total assets. It can be EBT or it can be after taxes, right? So it will depend upon the question whether you have to take it. You can take it before taxes also, you can take it after taxes also. That totally depends upon the question, right? What is earnings per share? What is earnings per share? Residual earnings. What is residual earnings, sir? I just told you. If I divide these residual earnings by number of equity shares, by number of equity shares, what I will get is the earnings per share, right? Now, what I can do with these earnings, let's say the earnings per share is 6 rupees. Now, it is the company's choice whether to pay this 6 rupees to the equity shareholders or not. Out of this 6 rupees, it is quite a possibility that company says we'll pay 3 rupees as dividend, and the remaining 3 rupees we will retain in the business because we want to do some expansion, sir. Right? We will retain and reinvest in the business. So what is EPS? Residual earnings divided by number of equity share. What is the dividend per share? That is the total equity dividend divided by number of equity shares. That will give you dividend per share. This 3 rupees, this is what? This is dividend per share, right? Dividend per share. If you are calculating the total dividend, let's say total dividend paid is 5 lakh rupees, and what is the total number of shares? That is 10 lakh. Sorry, yeah. So that way also dividend you can calculate. That will be less, quite less. If the dividend is 5 lakh and I say number of equity shares is 1 lakh. So what is the dividend per share? Per share you are getting a dividend of 5 rupees, right? Dividend payout ratio. Dividend payout ratio means out of the earnings of out of the earnings per share. Here in this example I have taken the earnings per share is 6. How much you are distributing as dividend? That is 3. That is 50%, sir. This is what is known as dividend payout ratio. Dividend payout ratio tells us that out of the earnings, how much of the dividend you are going to pay. Right? So next that we have is the price earnings ratio, market price per share divided by, what is price, sir? Price is market price. What is earnings? Earnings is EPS. So price to earnings ratio, market price per share divided by earnings per share, that whatever the earnings are, whatever you are earning per share, whether the market price is reflective of that or not. For example, your business is earning, let's say per share you are earning 100 rupees, which is considered to be very good. But the market price of your share is just 5 rupees or 10 rupees or let's say 50 rupees. Sir, if you are earning good, then your market price should also be good. So this is what, whether the market price is in accordance with what we are earning, right? Dividend yield ratio, that according to the market price per share, what is the dividend percentage that we are getting, whether we are getting, if the market price is too high, that means we should be getting the higher dividends, isn't it? We will be having the higher earnings, we should be getting the higher dividends. At the market price is reflective of what? The market price is reflective of the image of the business, that whether the business is doing good or not. So if the business is doing good, if the market price of the share is good, then obviously the dividend should also be good. Okay. Book value per share, that is the net worth divided by number of equity shares. Net worth is what, sir? We have already discussed, sir. Divided by number of equity shares. That will give you the book value per share. You already have studied, sir. We say 1 lakh shares, 1 lakh shares of rupees 10 each, right? This is what? This 10 is what? This is the book value per share. Clear? That is net worth. Net worth is equity share capital plus reserves and surplus divided by number of equity shares. Actually, what should be here is, if you want to calculate the book value per share, instead of net worth, it should be equity shareholders funds. It should be equity shareholders funds divided by number of equity shares. Or if you want to use the net worth, or it should be net worth divided by number of equity shares plus preference shares. Because the net worth is what? That is total equity, and equity includes the preference shares also, sir. Right? Then market value to book share, what is the market price per share? What is the value of the share in the book? So that is market price per share to book value per share. Clear? Then Q ratio, not at all important, sir. Q ratio is not at all important. Just go through it with once, nothing else. One second. Some issue there. Right. So Q ratio is not that important. Market value of equity and the liabilities, right? That is the total equity and the liabilities. Liabilities includes the debt also and the current liabilities also. If you talk about liabilities, that is the long-term debt also plus the current liabilities also, divided by the estimated replacement price of the cost of asset, that if you go to the market to replace the asset, at what price you will be able to replace it, whether you have the sufficient liabilities on that side, right? You have to pay the liabilities also, whether you have the equity also. So that is what is known as Q ratio. Not very important, not required to be focused on. Rest all the ratios are very important. So market value to book value per share, all the ratios are important. Now one last topic in the ratio analysis is DuPont analysis. What is that DuPont analysis, sir? Very simple. DuPont analysis is an extension of what? Is an extension of return on equity. We just studied about the return on equity, right? That is EBIT by equity or EAT by equity, return on equity. He says it can be calculated. It can be calculated in the different ways, that how the business can increase their return on the equity. He says that out of the total revenue here means sales, out of the total revenue, what is your net profit, right? Whether you are earning the sufficient net profit on the sales or not. If your sales is 1 crore rupees, but you are earning a net profit of, let's say, 50,000, is it good for the business? Sir, why are you earning 1 lakh? That means your expenditure is too high, right? He says a business can increase the return on equity if they focus on increasing the net profit to sales. If they focus on increasing what? If they focus on increasing then this ratio, net profit to sales ratio. Then asset turnover. Sir, whether you are using your assets effectively to generate sufficient sales or not, right? What he's trying to say is whether you are utilizing, a business can increase its return on the equity by effectively and efficiently utilizing the assets and increasing their sales. After that, the equity multiplier says whatever the owner's funds are there, whether you are employing, whether you are using those funds effectively or not. Shareholders equity, what are the assets that you are generating or investments that you are getting out of the owner's funds instead of the debt funds. What are the assets that you are employing using own funds, right? So return on equity is a combination of these three things, that is net profit divided by sales multiplied by sales divided by total assets, right sir, multiplied by total assets divided by equity, right? So this is what? This is net profit divided by equity, sir, or what we call it as EBIT or EAT if you want to consider, divided by equity, right? So this DuPont analysis is an extension of return on equity only, that how the business can increase their return on the equity. How they can do it? By focusing on generating more net profit for the sales, right? Controlling their expenditure, then utilizing their assets effectively, then utilizing the owner's equity funds, own funds effectively, and how they are being utilized for the various assets. Clear? So this was the last topic. With this, we are done with the ratio analysis. What you have to do is you have to solve the study mat questions after this. Do it. You have some brilliant question, and the most important questions which you will be getting in the ratio analysis. 99.99% you will be getting the balance sheet questions, sir. Balance sheet questions. In those type of questions, some information will be given to you, some information you will have to calculate, and you will have to complete the balance sheet, and you have some very good questions in the study mat itself. So first and the foremost thing, focus on the study material, focus on the ICAI study material, right? And you can join the ICAI study material series from our mobile app or from our website, the Financial Management Complete series, in which we have discussed each and every question in the in-depth. We have already made it available to you guys, right? Along with this, that is going to be really useful. You can do that if you wish to. Now with this, we are done with ratio analysis. The next chapter that we'll be taking up is, sir, which chapter? Let's take up investment decisions and capital budgeting, right? And most likely the capital budgeting chapter specifically is going to take a longer time, sir. We might divide it into two parts, right? Instead of doing it in one go, we might divide investment decisions into two parts, right? So see you guys in the next video with capital budgeting or investment decisions. Please, if you like this video, hit the like button and share with all your friends. And if you have not yet subscribed to the channel, big mistake you are committing. Do it right now and press the bell icon also, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.